Question 1. Which of the following statements best describes a limited pay whole life policy? A. It is a temporary policy that covers an insured for a specific period, after which coverage ends. B. Premiums are paid for a specified period, but coverage continues for the insured's entire life. C. The policy owner can adjust the premium payments and face amount after the policy is issued. D. It provides a death benefit and cash value, but premiums fluctuate based on market performance. Answer: B. Premiums are paid for a specified period, but coverage continues for the insured's entire life. A limited pay whole life policy is a type of permanent life insurance where premiums are paid for a limited number of years or until a specified age, but the policy's death benefit and cash value growth extend throughout the insured's entire life. For instance, a 20-pay life policy requires premiums for only 20 years, yet the coverage remains in force for life without further payments. This structure is ideal for those who prefer to complete their premium payments during their working years but desire lifelong coverage. Remember that limited pay refers to the premium payment period, not the coverage duration. Question 2. An insured has a health insurance policy with a $500 deductible and an 80/20 coinsurance clause. If the insured incurs medical expenses of $3,000, how much will the insurance company pay? A. $2,000. B. $2,500. C. $2,400. D. $2,000. Answer: D. $2,000. To calculate the insurance company's payment, first subtract the deductible from the total medical expenses, $3,000, total expense, $500, deductible, equals $2,500, remaining balance. Next, apply the coinsurance percentage, where the insurer pays 80% of the remaining balance, $2,500 asterisk 0.80 equals $2,000. Coinsurance means the insurer and insured share costs after the deductible is met, so the insured would be responsible for the $500 deductible plus 20% of the remaining $2,500, which is $500. This example shows how deductibles and coinsurance work together to determine out-of-pocket costs and insurer responsibility. Question 3. What is the purpose of the incontestability clause in a life insurance policy? A. It allows the insurer to contest the policy at any time for fraud. B. It prevents the insurer from denying a claim due to misstatements on the application after a specified period, usually 2 years. C. It ensures that the policy's cash value is always greater than the premiums paid. D. It allows the policy owner to reinstate a lapsed policy without evidence of insurability. Answer: B. It prevents the insurer from denying a claim due to misstatements on the application after a specified period, usually 2 years. The incontestability clause protects the policy owner by stating that, after a policy has been in force for a certain period, typically 2 years from the issue date, the insurer cannot deny a death benefit claim based on any misstatements, concealments, or fraud in the original application, unless the misstatement was fraudulent. This clause provides assurance to beneficiaries that a claim will not be disputed due to innocent errors made years ago during the application process. Think of it as a time limit for the insurer to discover and act upon any inaccuracies in the application. Question 4. An annuity characteristic that provides a guaranteed minimum interest rate and allows the annuity owner to participate in market growth is known as A. Fixed annuity. B. Variable annuity. C. Indexed annuity. D. Immediate annuity. Answer: C. Indexed annuity. An indexed annuity offers features of both fixed and variable annuities, providing a guaranteed minimum interest rate to protect against market downturns, while also allowing the contract owner to participate in potential market upside. Its interest credits are linked to the performance of a market index, such as the S&P 500, but with caps, participation rates, or spreads that limit the maximum gain. This type of annuity aims to offer growth potential beyond a traditional fixed annuity, without the direct market risk of a variable annuity. It's a common choice for those seeking a balance of security and growth. Question 5. Which type of disability income policy pays a monthly benefit for a specified period, typically 2 years, and then ceases payments? A. Short-term disability. B. Long-term disability. C. Accidental death and dismemberment. D. Workers' compensation. Answer: A. Short-term disability. Short-term disability, STD, insurance provides benefits for a limited period, typically ranging from a few weeks to up to 2 years, for illnesses or injuries that prevent an insured from working. It's designed to replace a portion of lost income during temporary periods of inability to work. In contrast, long-term disability, LTD, policies would cover longer periods, often up to retirement age, for more severe or permanent conditions. Understanding the term in short-term disability clarifies its limited duration. Question 6. What is the main advantage of group life insurance over individual life insurance? A. Group life insurance always offers higher coverage amounts. B. Group life insurance typically offers lower premiums and may not require individual medical underwriting. C. Group life insurance allows policy owners to build cash value more quickly. D. Group life insurance is convertible to an annuity at retirement. Answer: B. Group life insurance typically offers lower premiums and may not require individual medical underwriting. The primary advantage of group life insurance is its lower cost per unit of coverage and the fact that individuals often do not need to undergo individual medical underwriting to obtain coverage. This is because the risk is spread across a large group, making it more affordable for the insurer and more accessible for employees or members, even those with pre-existing conditions. For example, an employer offers a group life plan where all eligible employees are covered regardless of their health status, simplifying the process for everyone. This "no individual underwriting" feature is a key differentiator from individual policies. Question 7. A policy owner adds a waiver of premium rider to their life insurance policy. What benefit does this rider provide? A. It allows the policy owner to skip premium payments after the cash value reaches a certain amount. B. It ensures that the policy's death benefit increases annually without additional premium. C. It waives premium payments if the insured becomes totally and permanently disabled. D. It pays a benefit if the insured is hospitalized for more than 30 days. Answer: C. It waives premium payments if the insured becomes totally and permanently disabled. The waiver of premium rider is an invaluable addition to a life insurance policy, designed to keep coverage in force even if the insured becomes totally and permanently disabled. If the insured meets the policy's definition of disability, typically after a waiting period, the insurer will waive future premium payments, preventing the policy from lapsing. This rider provides financial security, ensuring that the death benefit remains intact without the burden of premium payments during a time of financial hardship. It's an important protection for the protection that ensures the policy doesn't lapse when it's most needed. Question 8. Which of the following is a characteristic of decreasing term life insurance? A. The premium decreases over the policy term, while the death benefit remains level. B. Both the premium and the death benefit remain level throughout the policy term. C. The premium remains level, but the death benefit decreases over the policy term. D. Both the premium and the death benefit increase over the policy term. Answer: C. The premium remains level, but the death benefit decreases over the policy term. Decreasing term life insurance is characterized by a level premium throughout the policy term, but a death benefit that gradually decreases over the life of the policy. This type of insurance is commonly used to cover a declining debt, such as a mortgage, where the amount owed decreases over time. For example, a homeowner might purchase a 30-year decreasing term policy to match their 30-year mortgage, ensuring that if they pass away, the insurance payout covers the remaining loan balance. The decreasing, in its name specifically refers to the death benefit amount. Question 9. In a health maintenance organization, HMO, a member is generally required to choose a specialist from outside the network. B. Primary care physician, PCP, who acts as a gatekeeper for referrals. C. Hospital that is not affiliated with the HMO. D. Deductible that is paid before any services are covered. Answer: B. Primary care physician, PCP, who acts as a gatekeeper for referrals. A key feature of a health maintenance organization, HMO, is the requirement for members to select a primary care physician, PCP, from the HMO's network. This PCP serves as a gatekeeper, coordinating all of the members' healthcare services and providing referrals to specialists within the HMO network. This model emphasizes preventative care and managed costs by controlling access to higher-cost services. The PCP is central to navigating care within an HMO plan. Question 10. Which beneficiary designation is most likely to ensure that if the named beneficiary dies before the insured, the death benefit will pass to the beneficiary's heirs? A. Per stirpes. B. Per capita. C. Revocable. D. Irrevocable. Answer: A. Per stirpes. A per stirpes beneficiary designation ensures that if a named beneficiary predeceases the insured, that beneficiary's share of the death benefit will pass to their direct descendants, their children, then grandchildren, etc. This differs from per capita, where the death benefit is divided equally among the surviving named beneficiaries, excluding the deceased beneficiary's heirs. For example, if a policy names 3 children per stirpes, and 1 child dies, that child's share goes to their children. This ensures generational transfer of the benefit. Question 11. Generally, premiums paid for individual life insurance policies are: A. Tax deductible. B. Tax deductible only if they exceed 7.5% of adjusted gross income. C. Not tax deductible. D. Tax deductible up to a certain limit set by the IRS. Answer: C. Not tax deductible. Generally, premiums paid for individual life insurance policies are considered a personal expense and are not tax deductible for federal income tax purposes. This is a common rule to remember when discussing the taxation of life insurance. While the death benefit is typically received income tax-free by beneficiaries, the premiums themselves are paid with after-tax dollars. Keep in mind that tax rules can vary for business-owned policies or certain employee benefits, but for personal policies, premiums are not deductible. Question 12. All of the following are typically covered by a long-term care policy, except: A. Nursing home care. B. Home health care. C. Adult day care. D. Acute care in a hospital. Answer: D. Acute care in a hospital. Long-term care, LTC, insurance policies are designed to cover services that assist individuals with daily living activities, like bathing, dressing, eating, or cognitive impairment, usually provided in settings such as nursing homes, assisted living facilities, or at home. Acute care, which refers to short-term medical treatment for severe injury or illness, typically provided in a hospital, is generally covered by health insurance, like Medicare or private health plans, not by a long-term care policy. Remember, LTC focuses on assistance with daily living, not medical treatment for acute conditions. Question 13. Which type of life insurance policy allows the policy owner to vary the amount of premium payments and the face amount? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is a flexible type of permanent life insurance that allows the policy owner to adjust both the amount and frequency of premium payments and to increase or decrease the policy's face amount, death benefit, within certain limits. This flexibility contrasts with traditional whole life, which has fixed premiums and a fixed death benefit. For example, if your financial situation changes, you might pay less into your universal life policy one year and more the next, as long as the cash value can support the policy costs. This adaptability makes universal life popular for those whose financial needs may change over time. Question 14. Which statement about variable life insurance is true? A. It has a guaranteed cash value and death benefit. B. The cash value is invested in the insurer's general account. C. The policy owner bears the investment risk. D. It does not require a securities license to sell. Answer: C. The policy owner bears the investment risk. Variable life insurance features a cash value component that is invested in a separate account, which consists of various investment options chosen by the policy owner, such as stocks, bonds, or money market funds. Because the cash value and death benefit, minimum guaranteed, fluctuate based on the performance of these underlying investments, the policy owner assumes the investment risk. This product is considered a security and thus requires a securities license, FINRA Series 6 or 7, to sell, in addition to a state life insurance license. The variable aspect signifies that the values can go up or down with market performance. Question 15. A lapsed life insurance policy can usually be reinstated within a certain period by paying back premiums, interest, and providing A. A new application form. B. A copy of the original policy. C. Evidence of insurability. D. Proof of financial hardship. Answer: C. Evidence of insurability. To reinstate a lapsed life insurance policy, the policy owner typically must pay all back premiums with interest, repay any policy loans, and, crucially, provide evidence of insurability. Evidence of insurability means demonstrating to the insurer that the insured is still in good health and meets the company's underwriting standards, often requiring a medical exam. This protects the insurer from adverse selection, ensuring the policy isn't being reinstated because the insured's health has significantly deteriorated. Remember that reinstatement is not automatic and depends on proving continued good health. Question 16. In health insurance, what is coinsurance? A. The amount the insured must pay before the insurer begins to pay. B. A fixed amount the insured pays for each medical service. C. The percentage of covered medical expenses that the insured pays after the deductible. D. The maximum amount an insured will pay in a year. Answer: C. The percentage of covered medical expenses that the insured pays after the deductible. Coinsurance is a cost-sharing provision in health insurance where the insured pays a specified percentage of covered medical expenses after the deductible has been met. For example, an 80/20ths coinsurance clause means the insurer pays 80% and the insured pays 20% of eligible costs after the deductible. This mechanism helps to reduce premiums for the insurer and encourages the insured to be more mindful of healthcare costs. Think of it as sharing the remaining bill after the initial deductible has been satisfied. Question 17. The policy loan provision in a whole life insurance policy allows the policy owner to A. Borrow against the policy's death benefit without repayment. B. Borrow up to the policy's cash value, with interest. C. Take out a loan from a bank using the policy as collateral. D. Access funds from the policy's dividend accumulation. Answer: B. Borrow up to the policy's cash value, with interest. The policy loan provision is a feature of whole life and other permanent life insurance policies that allows the policy owner to borrow money directly from the insurer, using the policy's accumulated cash value as collateral. The loan is not taxable income and does not have to be repaid, but unpaid loans and accrued interest will reduce the death benefit payable to beneficiaries. For instance, if a policy has $10,000 in cash value, the owner can borrow a portion of that amount, using it for any purpose. This provides a flexible source of funds. Question 18. What are non-forfeiture options in a whole life insurance policy? A. Options that allow the policy owner to receive dividends in cash. B. Options available to the policy owner if they stop paying premiums, ensuring the accumulated cash value is not forfeited. C. Riders that provide additional benefits to the policy at no extra cost. D. Provisions that prevent the insurer from canceling the policy due to non-payment of premiums. Answer: B. Options available to the policy owner if they stop paying premiums, ensuring the accumulated cash value is not forfeited. Non-forfeiture options are choices available to a policy owner who decides to surrender a whole life policy or stop paying premiums, ensuring that the accumulated cash value is not entirely lost or forfeited. These options typically include cash surrender value, taking the cash, reduced paid-up insurance, receiving a smaller, fully paid policy, or extended term insurance, using the cash value to purchase a term policy for the same face amount for a limited time. These provisions protect the policy owner's investment in the policy. Question 19. What is the primary purpose of a grace period in a life insurance policy? A. To allow the policy owner to increase the death benefit without new underwriting. B. To give the policy owner extra time to pay the premium before the policy lapses. C. To provide a period during which the policy can be surrendered for its full cash value. D. To allow the insured to change beneficiaries without penalty. Answer: B. To give the policy owner extra time to pay the premium before the policy lapses. The grace period in a life insurance policy is a specified period, typically 30 or 31 days after the premium due date, during which the policy remains in force even if the premium has not been paid. This allows the policy owner additional time to make the payment without the policy immediately lapsing. If the insured dies during the grace period, the death benefit is usually paid, minus any overdue premium. It acts as a safety net to prevent accidental lapse due to a slight delay in payment. Question 20. An insurance agent who misrepresents policy terms to induce a client to lapse an existing policy and purchase a new one is committing the illegal act of A. Rebating. B. Twisting. C. Churning. D. Defamation. Answer: B. Twisting. Twisting is an illegal practice in insurance where an agent makes a misrepresentation or incomplete comparison of an existing policy to induce a client to surrender, forfeit, or convert an existing policy in order to purchase a new one with the same insurer or a different one. The key element is the misrepresentation to the policyholder's detriment. This protects consumers from being misled into making financially unsound decisions regarding their insurance coverage. Churning is similar but involves replacing a policy within the same company for the sole purpose of generating new commissions. Question 21. Which benefit would typically be paid under an accidental death and dismemberment (AD&D) policy? A. A benefit for disability due to illness. B. A lump sum for loss of sight in one eye due to an accident. C. Monthly income for a permanent injury sustained while at work. D. Medical expenses incurred from a car accident. Answer: B. A lump sum for loss of sight in one eye due to an accident. An accidental death and dismemberment (AD&D) policy pays a lump sum benefit only if the insured's death or specified bodily injury, dismemberment, is caused directly by an accident. Dismemberment benefits, often referred to as capital sum or principal sum, are paid for the loss of a limb, sight, or hearing due to an accident. For example, if a policyholder loses an eye in a car accident, the AD&D policy would pay the predetermined dismemberment benefit. It does not cover illness, long-term disability, or medical expenses, only specific accidental losses. Question 22. Medicare Part B covers A. Inpatient hospital care. B. Skilled nursing facility care. C. Physician services and outpatient care. D. Prescription drugs. Answer: C. Physician services and outpatient care. Medicare Part B, also known as medical insurance, primarily covers medically necessary services and supplies that are typically received outside of a hospital inpatient setting. This includes physician services, outpatient hospital care, durable medical equipment, and some preventive services. For instance, an office visit to your doctor or a diagnostic test performed at an outpatient clinic would generally fall under Part B coverage. Remember, Part A covers hospital stays, and Part D covers prescription drugs, making Part B distinct for outpatient medical care. Question 23. Which program provides healthcare benefits to low-income individuals and families, and is jointly funded by the federal and state governments? A. Medicare. B. Medicaid. C. Social Security. D. Workers' compensation. Answer: B. Medicaid. Medicaid is a joint federal and state government program that provides healthcare coverage to eligible low-income individuals and families. Eligibility and specific benefits can vary by state, but the program aims to ensure that economically vulnerable populations have access to necessary medical care. This contrasts with Medicare, which primarily serves individuals aged 65 or older, or those with certain disabilities, regardless of income. Think of Medicaid as the safety net for those who cannot afford healthcare due to their financial situation. Question 24. The entire contract clause in a life insurance policy states that the policy and a copy of the application constitute the entire contract between the parties. What is the primary purpose of this clause? A. To allow the insurer to change policy terms at any time. B. To prevent the policy owner from making any changes to the policy. C. To ensure that no statements outside of the policy and application can be used to alter or contradict the contract. D. To require beneficiaries to sign off on all policy provisions. Answer: C. To ensure that no statements outside of the policy and application can be used to alter or contradict the contract. The entire contract clause ensures that the policy document itself, along with a copy of the original application, forms the complete and sole agreement between the policy owner and the insurance company. This provision prevents either party from introducing outside evidence or oral agreements to modify or contradict the policy's terms after it has been issued. For example, an agent's verbal promise that isn't in the written policy or application would not be enforceable, protecting both parties by clearly defining the agreed-upon terms. This clause simplifies contract interpretation and prevents disputes over alleged promises or representations. Question 25. What is the main difference between a participating and a non-participating life insurance policy? A. Participating policies offer higher death benefits. B. Non-participating policies have higher cash values. C. Participating policies may pay dividends to the policy owner, while non-participating policies do not. D. Non-participating policies have adjustable premiums. Answer: C. Participating policies may pay dividends to the policy owner, while non-participating policies do not. The core difference between a participating and a non-participating life insurance policy lies in the distribution of dividends. Participating policies, often issued by mutual insurance companies, allow policy owners to share in the insurer's surplus by receiving dividends, which are essentially a return of a portion of the premium. Non-participating policies, typically issued by stock companies, do not pay dividends. Instead, they usually offer lower, fixed premiums from the outset. For example, with a participating policy, you might receive a dividend check or have it used to reduce your next premium, something not possible with a non-participating policy.